Hi, I'm Paul Rabalais. I want to take a few moments and talk about the concept of gifting for purposes of avoiding estate and gift tax and transferring assets in a way that tax gets avoided or minimized. So, a little bit about my background. I have my law degree. I spent a year in Boston earning a master's degree in tax law from Boston University's law school. I am certified as a specialist in estate planning and administration by the Louisiana State Bar Association. I've written a book called Estate Planning in Louisiana. You see it over my right shoulder. And for the last 25 years, I've helped many families make sure that they transfer what they've worked for in a very simple and tax efficient way to their surviving family members. So I want to talk today about gifting. Gifting really doesn't even need to be discussed unless you're one of Louisiana's or America's wealthier people, because these days, here in 2016, when someone passes away, they can leave $5.45 million of assets free of estate tax, a 40% estate tax, free of estate tax to their family. If it's a married couple, really each spouse gets one of these $5.45 million exemptions. So the married couple, if things are set up right, and it's not too hard to set things up right, can exempt the first $10.9 million of assets from the 40% estate tax when they die. So, what's this gifting thing? Well, the gifting comes into play typically when somebody has more than that exemption amount. So let's take a single person. They have an $8 million estate. Good for them. And so obviously they face having to pay, or their estate faces having to pay some estate tax because it's more than the 5.45 million. And the estate tax is about 40%. So, but they have about $2.5 million more than the 5.45 million. So, estate faces roughly $1 million tax bill that would need to be paid to the IRS within 9 months after they die. So, many people want to avoid that, so they start looking at gifting. Now, many people, while not subject to the estate tax, many people know the rule that you can give, it's called the present interest gift tax annual exclusion. You can give up to $14,000 to as many people as you want to every year, and there's no gift and estate tax consequences. In fact, if you're married, each spouse can give $14,000, so the married couple can give up to $28,000 to as many people as they want to every year, and that starts perhaps to reduce the value of their estate that will be subject to estate tax when they die. The point most people miss out on, don't understand. Many people think that if you give more than $14,000 to someone in a year, well, somebody owes some tax on it. But nobody owes tax, even if you give more than $14,000 in a calendar year. So let's say, for example, Dad gave $114,000 to his daughter in 1 year. Well, the first $14,000 of it is free of gift and estate tax consequences, but he gave $114,000. He gave $100,000 more than the $14,000 that you're allowed to give. So who owes tax? Well, nobody. All Dad did by making a gift of $114,000 is he started to use some of his $5.45 million estate tax exemption. So nobody owes any tax because of Dad's $114,000 gift to his daughter, but because he made a $100,000 taxable gift, all that means is now when Dad dies, he can only leave $5.35 million of assets free of estate tax instead of $5.45 million. He used up $100,000 of his estate tax exemption. So that's a quick version of gifting. Now, what are the forms of gifting that you can make if you want to do some gifting? Again, most people don't need to do the gifting because they can leave everything in their estate, and a married couple can leave $10.9 million estate tax free, so they don't even need to get it out of their estate. But for those who have more, let's talk a little bit about the form of the gifting. Number one is you can just make gifts of cash. You can give $14,000 to as many people as you want to. If you have 3 children and 7 grandchildren, you can write each of them a check for $14,000. $140,000 out of your estate immediately. That won't be subject to estate tax when you die. You can do it every year. Some people give cash. Some people give stock. The concern about stock is if it's appreciated stock, then the people that you give the stock to, they're going to get your basis in the stock. So they may pay more tax when they sell the stock than if they would have paid had they inherited the stock from you when you died and you got the step up in basis, or they got the step up in basis. So be careful about gifts of appreciated stock or appreciated assets. Some people give for real estate. You can put your real estate into an entity like an LLC and give away, percentage interest in the LLC if you want to try to fit within the $14,000 or $28,000 threshold. Some people want to make gifts to their children and then see the children use that money to purchase life insurance on the parent's life so that when the parent dies, it perhaps will create an extra sum of money so that that money can be used to pay the estate tax that's still due. So that's another option. And another factor to consider is you can make gifts what's called outright, where you just give them the gift and they do what they want to with it. Or you can make gifts in trust. I suspect if you have maybe young grandchildren that you're gifting to, perhaps you don't want them to receive that gift and then go blow it. So you may put things in a trust for them. And got to be careful when you do that because and here's where we get into all the technical aspects. When you make a gift in trust for someone, it has to be what's called a crummy trust. Or in other words, you have to give them a present interest in the gift. This $14,000 rule only applies if you give them a present interest in the gift. By putting something in a trust for them to get later, you're not giving them a present interest. You're giving them a future interest. So if you give them a future interest, none of that $14,000 stuff applies. The gift is taxable $1, or at least uses up the estate tax exemption. But you can get around that by having what's called a crummy trust, where you say, okay, grandchild who's 19, I'm putting $14,000 in a trust for you. You have 30 days within which you can take the gift. And if you don't take the gift, then it's going to be locked up in that trust under the terms of the trust for you to get it much later. So there's another aspect when you're putting things in trust for people. You got to make sure you comply with those present interest annual exclusion rules. So it's kind of funny though, but for people who are considering giving appreciated assets, maybe it's better not to give those appreciated assets away. Maybe it's better to leave them in your estate. There's not going to be any estate tax unless you're over the threshold. And by leaving it in your name or in your estate, those appreciated assets will get a step up in capital gains tax basis when you die, so that when your children sell those assets, there'll be little or no tax to pay because they enjoyed the step up in basis. Those are a few of the gifting rules and the gifting circumstances that we see as we work with families, particularly Louisiana families who have done very well, want to maximize what goes to their family, want to minimize what goes to the government. So hope this has been able to help you a little bit, just start to understand the whole gift and estate tax sequence that we have. So I'm Paul Ramblay. Have a great day.